You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBSrollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode. Hey everyone, welcome back to another episode of QSBS Solved. My name is Brady, lucky to be joined by CJ Stermetz of EquityFTW, or Equity for the Win. CJ, how you doing?
Yeah, good, man. Thanks for having me on.
I know we missed a great conversation about fire and fat fire before we started recording. We were riffing on some of those things, but which is super applicable to employees who have, maybe a combined compensation package with equity and cash, and maybe a little bit more complexity than the average employee does. And that's really your client. That's who you work with.
Yeah. I mean, I live basically in Silicon Valley. I technically live down in Morgan Hill, which is like very edge of Silicon Valley. It's technically Santa Clara County somehow. I don't really know how, but it is. But fire stuff is all really fun to talk about. And the biggest thing that we were talking about is like the fire movement. Some advisors really hate it, but really it's evolved over the last 10 years, and it's much more aligned with how advisors talk with clients and help them think more about the stuff they actually want to do in life and how to make a plan for doing those things that they actually want to do in life. So it's always a fun discussion.
We were mentioning some things like, we think of, hey, get out of debt, eat rice and beans, retire, when you're 36 somehow. But then what do you do?
Yeah.
Do you just sit around? Probably not. So, holistic planning or early retirement planning also includes like, what aspirations do you have, and what
exactly
how often will you travel? And so, you think about all those things when you talk to employees who have high comp, complex comp, maybe compensation with equity components. And so maybe you can just give a short overview of the type of folks you work with and what those engagements typically look like, and then we can run through some different questions and complexities that come up.
Yeah. So, I mean, I work with a lot of people in tech. EquityFTW is known as an advice-only firm, which is a good match with a lot of people in tech. So we're weird in the sense that we don't charge an asset management fee of any kind, nor do we even take custody of client assets. So we will work with a client on either a one-time basis or ongoing basis and do all the same things that financial advisors do. So give advice on investments, insurance, retirement stuff, equity stuff, tax planning stuff. But it's a good match for people in tech because a lot of these people we also talked about this. So many people in tech are just so brilliantly smart that they just need a little bit of guidance and a little bit of sanity check when they're managing their finances, and they're willing to pay for it, and a lot of them have the money to pay for it. And so that's who we work with. My whole expertise is around equity comp stuff. I feel like that just kind of naturally happens after living where I've lived for the last almost coming up on 10 years. So
So for our listeners, like, your ears should perk up if you are a startup employee, almost regardless of stage, if you have equity compensation, but also probably just like, when you're at a startup, even if your compensation is incentive based in some way around, cash, a lot of times startups, the complexity or nuance of compensation packages, regardless of if there's equity or not, can be very different than maybe traditional work. And so to pay attention if that's you, but also if you're at a public company and RSUs or other types of compensation are a big part of your pay. So maybe some of those acronyms we can dive into a bit and start to understand. Like, let's start with the startup employee who doesn't have liquid equity. Maybe they have stock options that vest on a schedule and could be worth something in the future.
Yeah.
If that client comes to you, what's the first thing that comes to mind in terms of helping them set the context for what they actually have when they're issued stock options?
Yeah, I guess with stock options, so they're known as appreciation awards. So when you receive an option, they will only have value if the price of those options goes up over time. If your company doesn't grow or doesn't do anything, your options are basically worthless. So depending on the stage of the company that you're at, you can maybe think about your options in different ways. So like if you're joining a company that's been around, what's funny is the word startup is used for companies that have grown so big
Or
that
Stripe, and for
it's like they aren't really startups anymore. These
Sure.
are like huge corporations a lot of the times that are still granting options. But regardless, like you can base a lot of it just simply based off of you can just Google and figure out if how much money has the company raised. When you're granted options, is your exercise price on your options a penny, or is it like tens of dollars or twenties of dollars? Just even that is kind of indicative of what stage the company is at. But regardless of the option you receive, you're basing the entire value on future appreciation, and whether there are different types of stock options, and so there are different tax consequences and things to be aware of as far as that goes. But if you're receiving options, you need to have some appreciation from the company in order for them to actually be valuable to you.
If someone asks you, how do I evaluate my option package today? What's some guidance that you might give for them to understand the level of quote unquote risk they might want to take on with exercising their options over time, even when a potential liquidity event isn't actually on the horizon? And if that was a muddy question to ask, please clarify it. If so, you'll understand what I'm getting at.
Yeah, it's basically like if you're granted X amount of options, it's like, and you're the employee, how do I put this into context of anything? Is that basically what you're asking?
Yeah, like it's not worth anything today. And so they can say, oh, we're going to give you, 0.3% of the company. It's like, well, is the company going to exit for $1 billion, $10 billion, never exit at all? How do I evaluate that?
Yeah, I mean, if it's that case that you just stated, it's really like you should just be viewing your equity as kind of like a lottery ticket more than something to truly depend on.
Mm-hmm.
Especially if you're early on, knowing kind of the rough percentage of how much this equity would represent if they were shares, like what percentage of the company the actual shares would make up. I mean, that's kind of important to know. If you're joining a later startup and that percentage isn't really relevant, then it's more like you need to think through what is the company's expected timeline here. Like, are they actually trying to IPO at some point? I mean, most will say yes, of course, but like, is there a timeline that is somewhat believable? Like, can you actually envision a path to where you'll be able to maybe sell these options down the road? And sometimes it's like you can get a sense of that pretty quickly just by, if the company's only been around a year, the growth has been good, not amazing. It's like, yeah, it might be a while. But then as far as like the personal risk factor of, okay, when do I start thinking about exercising these options? Yeah, it's a very personal decision, but a lot of it comes down to, I mean, if like with any type of stock option, if you have 10,000 options and the exercise price is a penny, that's kind of easy to want to take on whatever future risk that might be because you're paying basically nothing. But if the exercise price is like, I don't know, $10 a share and you have 10,000 options, $100,000 for some people is no big deal. Like they'll gladly take on the risk of that investment potentially being worthless, but $100,000 to somebody else might be, I'll wait and see what happens.
Yeah, and to be clear, you don't necessarily have to exercise your options to get future value out of it if there is a liquidity event, right? So maybe can you just explain why even having option grant that goes unexercised when you hit a liquidity event, why that could still help?
Yeah, I mean, eventually, technically, it does. Like, if you can just hold on to your options and wait for something to happen, and then the mechanics eventually, when you sell, is basically you could do an immediate exercise and then sale of the options. But yeah, you without even exercising, you are still benefiting from whatever appreciation of the company's stock price. And that's one of the nice things. So even if you don't make any decisions about exercising, eventually you can benefit from you still benefit from the upside.
Many startups issue equity because they can't pay as much in cash compensation. But some startups are at a growth stage where they can very easily give you higher cash comp, but they still make a portion equity because they want you to feel involved in the upside. It's an additional incentive. You're probably working non-standard hours even at that startup, and so it's a good incentive structure. But are there any cases, and I know certainly you could have a case, but is it common for you to suggest that someone actually just like forego equity comp as part of a package when they're starting at a new company and ask for, say, higher cash compensations instead of options?
Yeah, that's a great question. I feel like that has happened, but it was more, I feel like usually it's been the client driving that more than me. It's like, I don't know. I like,
hey, do I really want 0.1% of this company that it's like, I don't know.
Yeah, I don't know. Like it's nice having at least a sliver of the pie, I guess. But yeah, it kind of depends on the person's situation. It's like if they really and just the numbers involved. Like if the extra cash would be meaningful and they don't want to bet on the upside of the company, then yeah, I could see that. I could see that being a recommendation, but it's just hard with the incentive structure and just the fact that, it could be worth this is always appealing. But yeah, cash is always really great to have. And more often than not, startups don't work and equity is worthless. So yeah, it is definitely an evaluation that you should make when, evaluating a potential offer at whatever startup.
Let's pivot to talk about RSUs. Tell us what RSUs stand for and what types of companies issue them, and if you're applying to work at different stage startups or public companies, what you should expect, maybe.
Yeah, so RSU stands for Restricted Stock Unit, and they can be granted or given by both private and public companies. And usually it's kind of a progression of, as a company becomes more and more mature, they go from granting different types of options to basically they go from granting incentive stock options at the beginning and non-qualified stock options at the beginning. And then as the company moves closer to a potential liquidity event or IPO, you'll see that they start granting RSUs. There's a lot of reasons why accounting is a little bit easier. Understanding of employee equity is a little bit easier with RSUs. It's easier to manage. But later stage private companies will typically offer these restricted stock units. And then public companies, pull up any company like listed on Yahoo, pull up any company you want that's publicly traded, and odds are they grant RSUs to their employees, or at least some of their employees. Yeah.
Okay.
What other questions do you have on RSUs?
So if I work at Google and I have part of my compensation is cash, part of my compensation is X. Is it number of or value of RSUs each pay period or each quarter, however it works? When clients come to you and they say, okay, I have all this cash. It's great cash comp, but then I have all this concentration in, say, Google stock. What are the early questions to start asking in determining how you handle that other part of compensation that's not cash?
Yeah. So I can take a step back too. So to explain a little bit more about RSUs between like a Google and a RSUs at a later stage private company. But so compared to options, where options are appreciation awards, RSUs are considered full value awards. So when you are granted one RSU, it is the equivalent basically of one share of the company's stock. So regardless of, say you're granted an option at $10 per share with an exercise price of $10 per share, if you're granted one RSU at $10 per share, your RSU is worth $10. Your option is worth $0 because of the exercise price being the same as the current value of it.
Yeah.
So RSUs are pretty neat because of the fact that it's just 1-to-1. It's easy to think about the value because you don't have to figure out whatever difference there is between the current value and exercise price. For public companies, that information is publicly available. So like for Google, if you have 10,000 Google shares, it's just or 10,000 Google RSUs. Well, they don't call them RSUs. They call them GSUs. So they're cool that way. So if you have 10,000 GSUs, it's just a matter of pulling up your website of choice, pulling up Google on Yahoo Finance and multiplying your 10,000 RSUs by the value of Google currently trading for, and that's how much they're currently worth. For private companies, they still base it on what's called the 409A valuation, and it's not a value that changes as frequently as as a company that's publicly traded. But yeah, I mean, it's figuring out the value of RSUs is much easier than options.
Sure. Right. And okay. So I have my cash grant. I have my equity grant. I'm sure there's a strategic way that I can minimize tax.
Yeah.
Because now I have all these. Now I have a capital gain. Is that correct? If I sell my stocks,
maybe.
Talk us through that. Yeah. Talk through what that looks like.
Yeah. So RSUs at a public company, usually you'll be subject to some sort of vesting schedule. And at a public company, it's nice because there can technically be performance measures too. So there can be RSUs that are granted based off of performance measures, but usually when we talk about RSUs, it's mostly just time vesting RSUs. So if I work at Google for 3 years, or let's just say 4 years for easier math, and I receive a grant, you can receive basically 25% per year. And then sometimes they'll even throw in more frequent vesting, like 25% year one, and then monthly vesting after that. But basically, if you receive a bunch of RSUs, they'll come to you over time. When they finally do come to you, it's treated as ordinary income. So not capital gains yet. So if I received, I don't know, I keep using 10,000. So let's just say you had 10,000 GSUs or RSUs vest, and the value of those, or the cash value of those, was $10,000. It's basically as though you had just received $10,000 in cash. And so your cost basis for determining long-term capital gains or short-term capital gains will be based on the value at vest. And that's something to be...
Right. So that means if at the time it vested, your one share of Google was worth $200,
yeah,
and eventually it goes to $215 and you sell it, you'll be taxed as capital gain on the difference.
Yep.
And that $200 basis that you had, you would be taxed as ordinary income.
Correct. Yeah, it's like that's already getting taxed.
That's cash compensation.
Yeah, basically, yep.
It's basically like they gave you cash on your W-2 and instantly purchase Google stock with it.
Yep,
Yeah.
exactly. Yeah, I mean, that's what a lot of advisors say. It's like, oh, if you received X amount of dollars in cash, what would you do with it? Would you go and then immediately buy your company's stock, or would you sell it and do something else? Yeah, I mean, that's usually what is said. It's a little bit more complicated than that, though, because it's not you receiving the cash and then buying. The company's literally just giving you stock. So because of you not having to do anything, the most common thing that happens is shares will just accumulate as they vest, and people just don't make a decision. There are also some other complexities, like some really easy mistakes people can make on RSUs. So there's a weird thing with RSUs with the tax withholding. For anybody who's at a public company, the RSUs are withheld at probably too low of a rate for what you're actually going to be taxed at. So the first $1 million of RSU compensation will be withheld at 22% at the federal level. And then once you cross $1 million, it'll withhold at 37%. But if you have a job in tech and you're receiving RSUs, you're pretty much guaranteed to have some under withholding. So it's something to be aware of as you're making a plan for taxes.
So that might be something that you adjust your withholding from the default when you're in that situation.
Yeah, some companies now, like NVIDIA, lets you change your withholding so that way this isn't even a problem. And that's becoming more popular. But yeah, otherwise it's you either adjust your other withholdings or you just make estimated tax payments, which oftentimes in California people are required to do if you're earning over $1 million.
Yeah, I guess let's think about some of the tax implications of like total exits or like full liquidity events for the company. Yeah. So this is something obviously that we deal with a lot, thinking about QSBS, especially for very, very early stage employees of companies. So maybe, I mean, it really depends every company, but before that company has probably raised, in most cases, has raised more than $50 or $75 million, depending on when the company was started and what stage of QSBS's legal life cycle it's in. So QSBS changed over the summer to include a little bit larger companies in that. And so generally, if you get shares in an early stage company, let's talk about the founder. So the founder gets stock on day one for a fraction of a penny. Maybe they own,
literally like 0.0001.
Exactly. 0.01. They own 20% of the company, maybe. Eventually, they get to a point where they're able to sell the company. Let's assume they just get acquired. It's not like an IPO or anything like that. They just get acquired. That stock, if they held it for 5 years, could be eligible for some pretty big tax savings.
Yep.
And so that could be great, especially if they get cash, because they might not have to pay up to, for QSBS, $10 million or $15 million. In taxes. But they could have another scenario where the acquirer acquires them for a portion of stock as well. So they could have,
as in they give them stock in exchange for their stock.
Exactly, right. And so there could be a cash component and there could be a stock component. How often do you work with clients who have been acquired and there's sort of a stock exchange for their acquirer, and now they're holding? It could be they went from having startup equity, a private company equity, to they got purchased by Intel, and they have public company stock.
But yeah, and you can edit this out if you want. But if that happens, those new shares can potentially qualify for QSBS, can they not?
That's right. Yeah.
So my memory is serving me correct then. So in a previous life before starting my firm, there was a client of ours who literally had that example happen where their company was acquired by a very large social media company, and they had QSBS eligible shares. The initial, if I remember right, basically they, before having worked with us, they sold their company's stock, or the new shares of the new company stock, did not claim QSBS. And then we later found it and said, hey, these were QSBS eligible, even though it was this company's stock. We need to go back and fix this. But yeah, I mean, it's very nice that that's.
Yeah, that's the sometimes we get a question that's like clients will ask us, could Apple stock be QSBS, or could Amazon stock be QSBS? And the answer is, well, if the company that you were at was QSBS and got acquired by Amazon, then a portion of it could be. And so the way that we think about it is it's a little bit like, and I don't want to muddy the water too much, but it's a little bit like your Google grants, where up to the basis was basically cash and then appreciation was something different.
Yep.
And so if you get acquired by, say, a public company and there's a stock exchange and a portion of the value that that company paid is stock, it could be that, you got an Apple shares of Apple with basically $100 basis, and up to that $100, it's QSBS in the future.
Yeah.
Any appreciation, you would just pay ordinary capital gains on. So those exchanges can be really powerful. And I think that a lot of that goes way under the radar in planning when startups exit, especially when startups are being, today we have a lot of these AI companies who are exiting to large public companies who are just trying to bolt
being
on.
acquired. Yeah.
Trying to bolt this on. And I wonder how often that's actually going way under the radar.
Yeah. I feel like just in the news today, there was one, I can't remember who, but yeah, I feel like it's happening all the time. And literally your example of QSBS-ness carrying over is something that happens and people should be aware of. Yeah.
Well, that's good that we got to pull in some QSBS on this episode of QSBS Solved.
Yes.
So yeah, if anyone has any questions about that, CJ is really going to be someone who can help you with that. Not accountants or attorneys here, at least on my side. But the variety of opportunities when dealing with early stage company stock, not just from a QSBS perspective, but just from a total tax planning perspective, are numerous. And a lot of times we only skim the surface on what can be accomplished when you're having.
Yeah. And the planning, and I mean, you probably see both sides where you work with people who have planned years in advance, and then you've probably worked with people who are like fire drill, like, oh my gosh, our company's being acquired. What should I do with all this stuff without ever having thought about it before? So the best place to be and where you can save yourself the most taxes is if, regardless of whether you're a founder or, joining later, when a company's already getting close to going public, regardless of the time you start or join a company, the time to start thinking about your equity and tax savings is sooner rather than later.
Yeah. Yeah. As with many things in finance.
Yeah, for sure. Yeah. Everything.
Yeah. Last thing I want to touch on here is what happens, if anything, and what should you consider if I'm moving from Google and I have a bunch of unvested RSUs or GSUs in that case to Amazon or to some other company. Maybe I'm actually moving the other direction. Maybe I'm going from a public company to a private company or a startup. What does changes in your employment status or where you work or who you work for change your previous grants?
So typically if you have unvested stuff, it will die when you leave. Away. It'll go away. And so when working with clients going from one public company to another public company, I usually recommend you got to leverage your existing grants to get some more equity, at least in the new place. I mean, companies, if you've been receiving X amount of RSUs per year in refresher grants is what they often call them, it's very likely a company will hopefully at a minimum be willing to match what you've been receiving. And you can, it's pretty easy to make the case. It's like, oh man, I really find the equity side of my compensation incentivizing. I always enjoyed it at whatever company. And it's not a lie, because it is it is incentivizing and it does align interests. But yeah, from going public to private, there's just more. I mean, if you're used to how easy liquidity is from your RSUs or just being at a public company, and then to go to private, it's just something that you personally need to be aware of, and you probably need to make sure you don't overvalue the equity of the private company you're receiving, because
I could see that happening. Someone moving from a public company to a private.
It happens all the time. It's like, oh yeah, it's like I worked here. It's like every company goes public. Eventually, what happened? What I was, my cadence of selling RSUs every so often, that's going to be me again at this new startup. And the reality is that may happen, but it also might not. And it's, just know that the access to liquidity won't come as easy. And so just totally something to be aware of.
Yeah, very good. All good advice. I think this is a good primer for folks who, this should have been helpful information, whether you're at a startup or you're at a public company, and they now know where to go to get their equity, understanding of their equity in the right place. So thanks.
I love writing about this stuff, and there are a lot of people who won't hire an advisor ever. And so I try to write as much as I can to help those people out too. So, but yeah, it's fun.
Thanks.
Yeah, it's fun coming on, and hopefully we'll be able to do it again sometime.
Thanks, CJ. Yep. Talk soon. See ya.
Cool. See ya.
Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change. Individual circumstances do vary.